Let me start with something simple. If you want to understand the Indian stock market, you cannot ignore banks. In this session, I'm going to help you understand the banking sector in a very practical way, not theory, not complicated jargon, just clear understanding. By the end of this training, you should know what banks actually do, how they make money, and how you can analyze banking stocks confidently. So let's begin with a simple question. Why should you even study banks? There are three very strong reasons. First, banks are the backbone of the economy. Every business needs a bank, every salaried person uses a bank, every loan, every transaction, every investment, it all goes through banks. Second, banks dominate the stock market. In India, banking stocks make up roughly 35 to 40% of the Nifty index. So, when banks perform well, the market usually performs well. Third, banks reflect economic health. When banks are stressed, the economy is usually slowing down. When banks are healthy, growth tends to improve. For example, between 2018 and 2020, rising NPS created stress in the banking system, and economic growth slowed during that period. So, if you understand banks, you understand a big part of the economy. Now, let's simplify what a bank actually is. At the simplest level, a bank is a middleman. It connects people who have extra money with people who need money. That's it. Suppose you deposit 1 lakh rupees in your savings account. The bank keeps that money safe. Now, someone else wants a home loan. The bank gives that person money, possibly your deposited money. The bank earns by charging higher interest on the loan than what it pays you on your deposit. That difference in interest is how banks survive. So, now the next question becomes how exactly do they make money? Banks earn in two main ways. First, per interest income, they pay you maybe 4% on your deposit, but they charge someone else 9% on a loan. That 5% difference is called the spread. That spread creates net interest income. Net interest income simply means interest earned minus interest paid. That is the core engine of bank profits. Second, non interest income. This includes ATM charges, credit card fees, loan processing fees, insurance commissions, mutual fund distribution income. So banks don't only earn from lending, they earn from services too. Now before we go deeper, we need to understand some important banking terms. Let's talk about interest rates. You've probably heard of the repo rate. Repo is the rate at which RBI lends money to banks. If RBI increases the repo rate, borrowing becomes expensive. Reverse repo rate is the opposite. That's when RBI borrows money from banks. Then there is term rate. This is simply the interest rate on a fixed period loan. For example, a 3-year loan at 9%. These rates are powerful tools. They control liquidity in the economy. They influence inflation. Now let's move to reserve requirements. CRR stands for cash reserve ratio. This means banks must keep a certain percentage of deposits with RBI in cash, currently around 4%, and banks earn zero interest on this amount. SLR stands for statutory liquidity ratio. This means banks must invest a percentage of deposits in government securities, currently around 18%. They earn interest here, but that money cannot be freely lent. So if CRR or SLR increases, banks have less money available to give as loans. Less lending can slow growth. Now you might wonder who controls all this. The central bank. A central bank is not like your regular bank. You cannot open a savings account there. Its job is bigger. It controls money supply. It sets key interest rates. It ensures the banking system remains stable. In India, the central bank is RBI, established in 1935. Every commercial bank in India is regulated by RBI, and globally, other central banks play similar roles. The Federal Reserve in the United States, the European Central Bank in Europe, the Bank of England in the UK. When these central banks change interest rates, markets across the world react. Even Indian markets are influenced by them. Now let's come back to India's banking structure. In India, we broadly have two large categories: public sector banks, majority owned by the government; private sector banks owned by private shareholders. Private banks generally focus heavily on efficiency and profitability. Public sector banks often have wider rural reach. Private banks usually adopt technology faster. Public sector banks historically have had higher NPRs. But as investors, you must compare numbers, not just ownership. Next, let's see different types of banks: public sector banks, private sector banks, small finance banks, cooperative banks, foreign banks operating in India. Each serves different customer segments, each operates under RBI regulation. Now let's move to what banks actually lend for. Banks mainly give two types of loans: retail loans, home loans, car loans, personal loans, education loans. These are smaller and spread across many customers. Then corporate loans, working capital, project finance, term loans. These are bigger in size and more sensitive to economic cycles. Banks also earn from deposit accounts, cards, insurance distribution, wealth management, digital payments, forex services. This income is called fee income. It is more stable. It doesn't depend directly on interest rate cycles, and that makes it very important. Now in the next video, we'll move to the most critical topic in banking analysis: non-performing assets. See you in the next video.